Hello guys, glad to have you on board again today. This is one of the live exercises in here, even though this one has been dealt with you in real time and is just recorded later on because there was so much shit to deal with in real time that I just didn't want to go down the burden of recording real-time stuff out there. But anyway, there has been a lot of prints left behind in the Discord just to assess the credibility of all of this, that all the messages have been sent prior to their actions, even though at some point, for my defense, some of those messages have sometimes been sent, as you can see in the timestamp in here, right when they actually occurred, which means it took me so much time to actually write down that shit that at some point posting the message was so late that basically, even though I tried to be anticipative regarding the market behaviors, basically to tell you things before they actually happen, otherwise it's pointless, then basically at some time it barely happened real fast and in real time, because Jesus motherfuck, it was so quick to react. And you have to assess that I'm doing this shit twice because I get to do it for French guys and then for you guys in English. So it was pretty tough to actually manage this thing in real time for both communities. But anyway, so this is one of the things we're going to try doing a little once in a while, when I'll see real-time opportunities in which I can see and can somehow spread out some educative content. I'm going to try either sending you a shit ton of messages to prove that we're dealing with this in real time, and then eventually record later on the educative podcast so that we can take time, breathe in, breathe out, to actually review what has been done, which is exactly the most appropriate stuff in here for this NASDAQ reverse, because Jesus, it has gone real fast. So let's go and jump right into it. Okay, so you've got all the tracks in here, trails that you can review as of real-time management that has been done with regarding this trade. Okay, and of course we're going to just kind of review all of what happened step by step and how you should have navigated this thing if you are an intermediate trader looking for a pullback trade. Okay, so first of all, you need to be sure that the pullback trade happens in a reversal context, or it happens in a trend context, which means you need to see a trend. If there are no ongoing trend purposes, then there is no pullback to come. If there has already been a pullback, then they're very less likely going to happen another one into the same time frame. So you don't double the pullbacks. You generally deal with multiple pullbacks if they are multi-time frame trends going on. Like you can have a 15-minute pullbacks that can come out of creating an H1 pullback later on, but you can very rarely see 15 minutes pullback happening one after another. There's still some very rare cases in which this happen, but of course they're negligible in terms of percentage of occurrences. So we better like to trade that once the pullback happen, Jesus, you need to move to a higher time frame if you want to see another one. Okay, so first things first, like we said, we need a trend. So a trend always comes from a mature range that causes a reverse. Though in here in the NASDAQ, we do have one of many specific cases to alter that rule, in a perspective that we do have a freakingly excessive bullish market, and these markets don't range before reversing. They go from bullish to bearish, which is exactly what we've seen there. So the market early reversed, built a third range boundary, and reversed immediately out of this and going from bullish to bearish, basically V-shaped reverse on the higher time frames. Okay, so that's what happens after being bullish and breaking some resistance. We immediately broke in supports and initiated the bearish trend. Where did the breakout occur? Definitely out there. You can see breakout patterns not retracing to the breakout level 2 times in a row, fucking up support context and trend channel in the same time. This is definitely where the trend emerged. Of course, shit hits the fan for everyone, and sometimes I'm very unlucky, which is exactly what happened to me in there. You know, I'm looking for this reverse for, a long fucking time, and that ended up being the exact timing in which I was at hospital for just random basic checkup, nothing big, no big deal, but this shit took me approximately 2 fucking hours, and I was off the network. So the problem is I didn't even notice what happened, but just going back to the market 2 hours ago, just 2 hours, all right, but just I left the market in here, sending notifications saying, all right, this is the big deal, we definitely need to have a look at prices and stuff like that, but I never thought that price will fuck up. just right within those 2 hours. And this is exactly what happened. I woke up 2 hours later in here, and of course the entire breakout was already going on. So too late. And when things are late, what you do is not trying to catch up on them, but try to smartly move on to some other trend follow stuff or whatever. I missed the breakout, piece of shit, but whatever, shit happens and you have to deal with it. So I had to wait for opportunities. Basically, the goal in here was to set the plan on motion. What the fuck can I do to catch up on this? The only availability things I had, as the breakout was really on there, I couldn't even do anything else but to wait for a pullback. So I had to wait for the market to build a dip structure. This is where it did, highlighted by the indicator that showed some kind of trendy opportunities. Exit pattern, definitely a worthy thing to figure out that the divergence was going on. After the breakout, things were slowing a bit. This is where we built the divergence, okay? But anyway, that's not the trade I'm looking for. I'm just definitely not looking at buying this shit, but selling it. So I know that after comes the divergence, here comes the pullback. So this is one of the many elements you need as a pre-required system before looking at a pullback. Before assessing the probability for a pullback, you must see the breakout clearly. You must see a slowing down pace pattern type of a divergence, okay? This one is really a classical one. You can see the market making new lows, not the momentum. Exit pattern, which is a very tough risk management, and even the algorithms picked the timing out there. So it's really an appropriate reverse or kind of trendy trade, no more, no less, okay? So what we're looking for, as what the definition of a pullback trade is no less than just a mature range on the lower time frame. So what's that shit, and how do we actually navigate this thing? So let me just tell you all about it. The first things you want to do in this context is put in your fibs. So Fibonacci retracement is absolutely required into this pattern, okay? So you put them market top to market bottom, or at least the current market bottom, and you must be aware that there is no pullback until you at least retrace 23%. And you're going to have to deal and trade closer to those Fibonacci level. This is where the speculative clusters will be. So you trade close or as close as possible to the 23, close or as close as possible to the 38, or eventually close or as close to the 50%, no more. If you're retracing 61%, you're in a fucking range. You're definitely no longer in a pullback, okay? So all of this must happen into the lower time frame, which means what we care about is oscillating across the trend channel, okay? Remember that trend channel in here, which is this tinier line, okay, is the lower time frame context. So if you have problems reading it, which we clearly do have in here, you must be sure that the market has made at least 4 contacts over this thing, okay? We're going to go to the lower time frames to make it real clear for you, but the pullback happens when you have a mature range on the lower time frame retracing and reversing closer to the 23 or 38% fib. Though in here you do have a very nice pullback. The pullback also needs to set one additional rule to be absolutely validated, which means you need to be on top of 50% context. Which means in here you take the context width and you set a line into 50% of it. Okay, normally it's already drawn into your indicator, not mine because I've been setting it into a different setting. But if I was doing it, let me just switch back to the normal pro channel stuff. All right, you'll get your 50% line drawn right in the middle. So I'm sorry, I think I just can't fucking replay those futures contracts. But okay, here you see you got the 50% line, which is drawn normally by your normal standing indicator. So you need to see this one at least closing one time on top of this 50% line to confirm that the pullback has occurred. Okay, so this is the many rules you get. Closing, trading as close to possible from the Fibonacci retracement, no more than 50%. You need to retrace to at least 50% of the context to find a viable tradable area, and you need to see a mature range, okay? That's a set of rules that might sound a little bit complicated, but you'll see this is not that much. So let's get to the lower time frames and deal with the range and what it actually looks like. So I'm sorry I can't replay this shit. That would be much better if you've seen this thing in real time. So here is where my divergence pattern occurred on the higher time frame. So this is where I'm start counting my waves. All I care about is the market not making new low points, okay? And the market coming across context. Remember that ranges comes from market rejecting multiple contexts in a row. So here's what happens, okay? The context boxes are pretty much unfolding, so volatile shit's down the corner. That's the least we could say regarding what happened to the Nasdaq this day. So pullbacking, reversing the context, and therefore validating this as a potential temporary reverse. We get back to the next context, which is the second and third range boundary. Okay, so this one is the third, first, second, third times we go from context to context. Here comes the fourth time, not enough on this one. It would have required a slightly bit more to actually be counted as much, so we're still dealing with the four range boundary. Here comes the fifth and sixth in here. That's the structure of a range. So I'm going to teach you how to navigate this thing as time passes by, okay? So when you have your plan, you don't know if things will actually get to trigger. You're going to have to navigate the short-term risk management. So what that means is that, first and foremost, you don't take this trade unless you're frequently experienced, because that means trading counter-trendy trade as trading the divergence, okay? So you don't do this. You wait for the market to at least get to the reversal context, which will build your second range boundary. Trade that you certainly don't want to catch, a very experienced type of trade, so you definitely don't go down this road. You're not ready for it. It's an expert context. So what you do next is you wait for the context to be reversed, and you wait for the typical third range boundary. You want the one you already know if you're an intermediate trader. So you know this is where the third range boundary is. Okay, which means you trade it, you don't trade it. That depends on the signals you get and the risk management and how you want to deal with it. But anyway, what matters is that after the third range boundary comes the fourth, which is the one we care about in trend following. But in order to get a fourth range boundary, you need to place the third range boundary well. So this is where you know. Whether you trade it or not, you don't give a shit. You just know that starting now, anytime you'll get to the resistant context is where you're going to look for probabilities to get the range trade you want, the pullback trade you want, because for range boundary means the range is mature. Remember one of the rules we said it earlier, you need a mature range. So you need to be 3+ range boundary. So as long as you get to the fourth range boundary, this is where you're going to get to look for your range trade, for your pullback trade. So why don't we take this one? Okay, it fits the number of rule that we get to 4 range boundaries, which is fine, but there's several other rules that we certainly don't met out there. So the first one is we don't even retrace 23%, end of the story. We fail into one crucial key rule, just get the fuck out. This trade doesn't rely, at least not importantly. We just wait for prices to reach out the closer area of 23. That doesn't have to be at 23, it just needs to be closer to, okay? It really matters that much. So don't be very, very precise on the levels. It's just get as close as possible to it and find risk managements, okay? So as you get in here, oh, nice, 23% Fibonacci. We're still dealing with the fourth range boundary, which is first, second, third, okay? And looking at the fourth one, but in here failed to get to the context, so actually the fourth range boundary is out there. You can only validate a boundary when the market reaches out to the opposite context. So in here, even if we had a pullback, even if it looks significant, it wasn't significant enough to consider the fourth range boundary validated. So it gone higher, retraced to the 23%, and as we succeed reaching out the opposite context is where we can validate the fourth range boundary. So when you get a validated fourth range boundary, you can do something. You can build the range structure, which is something you're definitely going to have to do for pullback trades, okay? And any other trend following stuff and breakout patterns, whatever, you need to build this thing. In order to do it, you need to get the fourth boundary validated, which means being back to the context. At that point, what you're going to be doing is gathering many tools. I mean, there are many options. I'm just going to take this one, which is fairly easy for me to manage, which is parallel line, okay? And I'm basically going to start assessing my thing. I'm going to draw 2 trend lines, okay? The first one being, I want to go from this point, okay, down, right up to the fourth range boundary, okay? So second and fourth range boundary align, okay? And you draw that trend line. The second trend line you want to be drawing is basically going right back to third range boundary, which is in here, okay, and align it with the first range boundary. Okay, so this is my thing. This is my ranging structure. Okay, let me just terminate and align this thing. Okay, I want to align these 2 points. So how did I build this thing? Aligning this and this to build this trend line, and aligning this and this, okay, second and fourth range with 1 and 3rd, and we basically draw 2 trend lines. In here, that gives us a divergent wedge pattern. The lines are diverging, either of converging, they could be doing this, converging to a point, or diverging. In here, they're diverging. This is the worst possible case scenario. That means volatility and very complex shit to navigate. And that's exactly what happened in here. So the algorithm detected a fairly reasonable pattern in here, and that's exactly what we're looking at. Remember, we need a mature range to deal with the pullback. What is this signal? All right, Jesus, that's exactly it. That means the algorithm has detected a mature range. Oh, that's exactly what we want. So we're gonna go in without even asking a question. 23% Fibonacci retracement, mature range, and mature range signal detected by the algorithm. So we definitely go down this road. So we take that trade. Okay, we approximately size the stop loss from the size of the trend channel, which means we do have a stop loss in here. If you want to go low risk, you want to put it on top of the 38%, okay? So in that perspective, that depends on the type of signals you get. In here, I would say the algorithm detects it. You do have a trending fucking signal. Okay, just fucking go in. So I would say in here, you go full position sizing, tiny stop loss, and you definitely want the market to validate this. Oh, great, it validates pretty rapidly. But then comes the NFP right in here. So there was the NFP, and the market actually had a good number. I mean, the number was far better than expected. So we actually managed to create an excessive movement. So in here, either you had your stop loss in here and you paid for it in here with your risk management, and in that perspective, you just let it go, right? The market is going higher than your entry price, but it's certainly not exiting the pattern, okay? This is your range. We don't break out of the range. So when the market goes there, you do as you please, okay? But personally, I decided to go full risk, which means I didn't profit take in here and just put in my stop at break even. So I got stopped out in here. But when I saw this, oh shit, I re-entered immediately, and even with a bigger position. Because this is another type of experience signal. I'm not going to go down the details out there, but this is basically a pattern that says deal with the volatility boundary. And guess what? We had the volatility boundary going right there. So we were at the volatility boundary on the top area of my range. Even though we weren't perfectly aligned with the 23 or the 38% fib, I decided that was far more than enough. We had an overbought structure, so overbought cluster on a volatility boundary with a volatility alert at the range boundary. Fuck that, I'm back in the game. So of course, I'm back with a tiny stop loss because I'm dealing with a volatility boundary trade out there, and the market instantly reacts, goes right back to the bottom area. And that is another pattern I teach to the experienced guy. When you get a volatility trade on a mature range, generally means the breakout is going to occur right after. So this time, the probability for the breakout out there was significantly, never 100%, but it was definitely significant. So in that perspective, what I did is I took the breakout trades, but I'll explain how I did this. Of course, once again, you've got all the details on how these things have gone navigated. Remember what I've said earlier, how to draw the range and stuff like that. All of these things have been explained in real time, okay? So we were navigating this thing. Of course, in here, I'll tell you that it took me a lot of time to write those messages. I'm really late on posting them, but anyway, that's a typical final excessive context we kind of have to deal with. All of those things. Where the fuck is the breakout trade I told you about? Okay, so that was the breakout trade. Blah, 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 blah. Okay, that's what I told you. Okay, when the breakout is too quick, when the prices are surging so fast, you're going to need to wait for candle closes to validate, okay? Because remember that a breakout only occurs when you see this motherfucking signal, or at least you see a very, very breakout candle, and sometimes the algorithm won't perfectly detect it, but in here it was absolutely perfect. So we had a 3-minute breakout, okay? This one validated when this candle closed. So let me just zoom in to be precise. It actually validated at the close of this candle. So this is where you knew, okay? So what I do in these cases, I'll teach you that pattern because it's really, really important for you to get that, okay? When the third range boundary is built, okay, you take the open price of the candle that reversed it, okay, on pullbacks, and you draw a trend line out of this, okay? And once the trend line is drawn, okay, what you're going to be doing is that you're going to be trading this level. Okay, so when the breakout occurs, you just put a tiny order in the books and wait to be executed. So that gives you a slightly better price than trading the closed candle, because most of the time the market will get to retest the third range boundary. So this is my first reinforcement trade. I'm reinforcing, not doubling the position, of course. Here's my initial position. I'm taking a 25% size reinforcement out there, okay? So let's assume I had 4 contracts in here. I'm just adding a single contract to get up to 5, okay? Of course, the market keeps pushing, which is great. And actually in here, it actually triggered a 15-minute breakout on top of this, which means we had the 3-minute breakout pattern detected. And we broke the 15-minute context as well. So when this candle closed, this one, okay, I knew that I could be triggering the pattern on the 15-minute chart as well. So another breakout on the higher time frame. And in that perspective, what have I done? I've put in my order exactly into the same price as I did earlier. So I've done actually 2 breakout trades at once, 2 at the same levels. And just look at that. First one has been triggered in here, second one perfectly at the upper shadow candle of this thing, and damn, the market goes wild after. Of course, as this was a pullback, I know the next trade is a final excess, which means anytime I see a breakout target on top, below the support context and making new lows, I know this is where I want to profit take. So this is where my profit taking was. It was pure and simply. I needed to trigger this on the 15-minute chart, of course, but in this specific case, both breakouts were signaling the same level. So I was targeting this target, which was exactly the same price as the 3-minute breakout target. Okay, but this is where I mandatory profit take. I don't give a shit the market goes lower or whatever. It's just this is where it ends to me. I'm below the context. I have done my pullback, which means this is a final excess. When the market tries to accelerate through context after a pullback, I know odds are fairly significant that the market will fail. So I'm profit taking out there. That's how these things navigate. You get the pullback, you wait for the market to make new lows or new highs if that's a bullish breakout, and of course when you see a target on top or below the context, you get the fuck out. Either you wait for a signal, but in this perspective, just look at how violent the breakout was. I certainly didn't want to wait for a huge V-shaped reverse, which means I definitely limit my trade and get the fuck out of there. Okay, so that's how you navigate these pullback trade. Pullback is the summation of core informations of being a mature range on the lower time frames, terminating and giving lower time frame signals. It's absolutely necessary that you get a signal into the 3-minute chart, okay? And you've got an additional layer of risk management on top of that. Means generally, if you want to get the best case scenario in order to trade these pullbacks, you generally want to see a signal on this time frame, okay, the higher time frame. And it definitely must be a red signal, okay, either a red dot, which is overbought, or a divergence, whatever, but a red signal, okay. In here, this one was great, okay, but as you can see, it wasn't perfect because it wasn't triggering the cyclical alert. So in here, it feels like we were ready to go, but just needed to wait a little bit more for the cyclical pattern to trigger. So it actually was just absolutely perfect in here because we had another bearish trending signal with the cyclical activity being confirming this. Okay, so anyway, what matters in here is mature range, retracing or terminating its structure closer to a Fibonacci retracement, not exceeding 50% retracement, we're fine. And what you get to trade is you take a trade in here, speculative trade, okay, and you can take the breakout trade that can occur later on, okay? That's how this thing goes. And when you get to reach out the target or shows a signal near target, just get the fuck out. It's pure and simply how these things works. It's not very complicated, but it requires range mastering because you need to be navigating the short-term range, waiting for the third range boundary to come, and you're going to catch up any reversal trade that can show up closer to the Fibonacci. And if this one didn't work out, we would have waited for this one to show up. There has been an intermediate trade, which was this one, a volatility trade that triggers slightly later on, but normally, for those who took the previous trade, they should still be in. Normally the stop losses haven't been triggered, and they should have just gone wild. Okay? So I hope these things are clear enough in your mind. It requires, of course, a lot of practicing because these are intermediate structures, so they require assessing what a trend is and, most importantly, being able to fairly easily navigate ranging structure. Because this one is not about dealing with the third range boundary, but dealing about the boundary that comes right after. Okay? So you know that after a third range boundary and only after a validated third range boundary comes the range structure and the mature range structure that you'll eventually get to trend follow on. Okay, so this is a trend follow opportunity. That's how it goes. There are many other contexts in which you can trend follow, like accumulations and stuff like that, that have slightly different rules. But in here, this one is something you need to know about. How to navigate those range, how to draw your range boundary as the range matures into the lower time frames and trade the breakout of this structure. Either you miss this trade, and this time sometimes it will happen. You miss the speculative trade, but you can still profit from the breakdown. Okay? That being said, I think that's going to be more than enough for today. Thank you guys for attending. We'll make plenty of those other videos in real-time application, even though, like I said, this one is a little bit different because I wasn't able to record in real time. Therefore, I posted messages into Discord for real-time application, and we're just reviewing this cool and slowly today. Okay, wish you guys the best, and see you on the next one.